a massive black swan disaster. To hit Bitcoin in 2026 sounds dramatic, but if you miss the one catalyst that can drop Bitcoin 30 to 60% in a month, you'll think you're fine, right up until you're forced to sell. You clicked this because you want the crash before it shows up on your feed, and the part that matters isn't the price level, it's the mechanism that makes the drop feel instant. Because here's the uncomfortable truth. Most people don't lose money in crypto because they're wrong about Bitcoin long term. They lose money because the way the drop happens makes them do the worst possible thing at the worst possible time. And the black swan I'm talking about isn't Bitcoin is dead or hash rate collapses or some spooky chart pattern. It's a sequence, a chain reaction, a very human chain reaction. Let me put you inside it. You wake up, you check price, and Bitcoin is down. Not 2%, not 5%. It's down 12%. Then you refresh and it's down 16%. And you tell yourself, okay, this is just leverage flushing out. And you'd be right for about an hour. Then the story changes, not slowly, it snaps, because the drop isn't just a drop anymore, it's the kind of drop that turns your group chats into silence. It's the kind of drop where exchanges start protecting users. It's the kind of drop where you discover how much of your confidence was actually borrowed from a calm market. And if you've been in crypto long enough, you know exactly what I mean by that phrase. Calm markets lend you confidence. Violent markets take it back with interest. So what could realistically do that in 2026? Most people will point at one of three things. They'll say it's the halving cycle. The peak is done. Or liquidity is back, so crashes are buying opportunities. Or politics is noise, Bitcoin doesn't care. Each one has a piece of truth, and each one can still get you wrecked if you treat it like the whole truth. Because a black swan doesn't announce itself as a black swan. It announces itself as something that seems manageable, something you've seen before, until it isn't. So I'm going to do two things with you. First, I'm going to show you the setup that makes a 2026 crash plausible, even if you're bullish, not bearish. Bullish. That's important. Second, I'm going to show you the trigger that can turn a normal correction into a disorderly, confidence-breaking event, the kind that changes how you behave for years. And I'm not going to start with charts. I'm not going to start with some grand theory. I'm going to start with the one question that decides whether you survive the move emotionally. Are you a voluntary holder or a forced seller? Because forced sellers don't choose anything, they react. And black swans hunt reactions. Think about the last time crypto really hurt. Not the last time you felt annoyed. The last time you felt that physical tension in your chest, like the market was watching you personally. What made it hurt wasn't the red candles, it was the speed. It was how quickly your brain went from this is fine to what if I'm the exit liquidity. Now here's the trap. When people talk about 2026, they're usually talking about the peak. Where does Bitcoin top? How high can it go? Is it 175? Is it 200? Is it something else? That conversation is entertaining. It's also how people sleepwalk into the real risk. Because the most dangerous part of a bull cycle is when everyone is preparing for upside and almost nobody is preparing for the cost of upside. And the cost is volatility, not the cute kind. The kind that makes you question your memory, like, wait, didn't we all agree this was going up? So let's define what black swan means in a way that's actually useful. It's not just a bad event. It's an event that changes the rules of how the market trades, even if only for a short window. Liquidity disappears. Bid-ask spreads widen. Correlations snap into place. Everything starts moving together, and your nice, clean plan becomes a mess because execution becomes the problem. That's the thing most people miss. In a normal market, you can be wrong and still manage your way through it. In a black swan, management fails, not because you're stupid, because the market stops behaving like the market you're used to. So what's the setup in crypto right now that makes a black swan more likely in 2026 than people want to admit? It's not just leverage. Leverage is always there. It's not just macro. Macro is always there, it's structure. Crypto in the last couple years has become more financialized. That's a fancy word, but the idea is simple. More people now get exposure through products, wrappers, funds, and platforms that behave like traditional markets. That includes spot ETFs, big treasury-style buyers, large quant flows, and an ecosystem where a lot of Bitcoin demand is actually demand for a vehicle that holds Bitcoin. That sounds bullish, and it is bullish, until it's the reason the exit door gets smaller. Because when exposure is easy, inflows can be huge. But when exposure is easy, outflows can be huge too. And outflows tend to move faster than inflows, because fear is a better sprinter than greed. Now add one more layer. A lot of capital that entered through safe-looking wrappers did not enter with a 4-year brain. It entered with a quarterly brain. A risk committee brain, a rebalance if it breaks this level brain. And I'm not saying that's evil, I'm saying it changes the behavior of the market during stress. So here's the first open loop I want you to hold. The black swan isn't just a thing that happens to Bitcoin. It's a thing that happens to the people holding Bitcoin because of how they're holding it. We'll come back to that because it connects directly to the trigger. But first, I want you to picture the most common mindset going into 2026. You've heard some version of liquidity is going to return, rates will likely trend down, money finds its way into risk assets. Bitcoin has a sensitivity to liquidity. The tide rises, the boats rise. Okay, even if you agree with that, here's the twist. The same world that creates the liquidity tailwind also creates the political and financial stress that increases the odds of an abrupt confidence shock, so you can have a bull thesis and still have a crash. And this is where people get emotionally lazy. They think bullish means up only, or bearish means down only. Reality is a lot more mean than that. Reality is up, then down hard, then up again. And the down hard is what selects who actually gets the upside. Now let's talk about the kind of black swan that is most plausible in 2026. Not an asteroid, not some fantasy. A credibility event. A credibility event is when something happens that makes institutions, funds, platforms, or regulators behave differently for a window of time. Even if the underlying asset is fine, the plumbing gets clogged. The ability to move capital gets restricted. Risk controls flip on. Liquidity providers step back, and in that window, prices can overshoot to the downside because the market isn't a market, it's a stampede. What could cause a credibility event? I'll give you a few categories, and I want you to notice how none of them require Bitcoin fails. 1. A major exchange or prime broker faces a sudden solvency scare even if it survives. The rumor alone can be enough. 2. A stablecoin shock. Not stablecoins go away. A temporary break in trust, a depeg scare, a freeze event, a court action, a settlement, a sudden shift in redemption behavior. Anything that makes people say, wait, can I get out when I want to? 3. An emergency regulatory or legal action that changes access for a short period. The key word is emergency. Not a long legislative process, something that lands like a hammer. 4. A broader macro event that forces liquidation across assets, where Bitcoin trades like the most liquid risk asset in the room. People don't sell what they hate, they sell what they can. And 5, political uncertainty that bleeds into markets, not as a debate on TV, but as a reason big money temporarily reduces risk. If you're already thinking, okay, but which one is it? Stay with me. We're narrowing this down to the one mechanism that can turn normal crash into disaster crash. Because a normal crash is survivable for most people if they're positioned right. A disaster crash is the one where you're not just down, you're trapped. And being trapped is what breaks people. Let's talk about trapped. Trapped isn't prices down. Trapped is I can't execute what I planned. Trapped is when withdrawals are delayed. Trapped is when spreads are wide. Trapped is when the platform you thought was a utility turns into a gatekeeper. And yes, I'm going to say something blunt. And if it annoys you, good, because it might protect you. If you've never lived through an environment where platforms restrict you for your safety, you don't actually know your risk level. You know your risk level in a normal day. You don't know your risk level in a chaotic day. And black swans are chaotic days. Now, a quick note, because this matters for trust. When I mention exchanges in this video, some links may be affiliate links. That means if you choose to sign up through one of those links, it can support the channel at no extra cost to you. If you don't want to use those links, don't. You can go directly to any platform site. Either way, the point I'm making is about risk mechanics, not about pushing you anywhere. And since you selected exchanges as an element, let's be practical. The biggest mistake people make with exchanges isn't using them. It's using them as if they're a vault. They're not a vault, they're a venue. They're a place to transact. And venues have policies. Venues have KYC rules. Venues can change limits. Venues can experience downtime. Venues can prioritize risk controls when volumes spike. So if you rely on a venue functioning perfectly during the exact hour, everyone rushes to the door, you're betting your mental health on a system you don't control. That's the trap. Now let's take the interview idea you shared and sharpen it into a warning narrative. The bullish thesis says, liquidity returns, rates ease, the system has to print, and assets float higher. The skeptical thesis says the economy weakens, politics gets messy, and risk assets wobble. The Black Swan view says both can be true, and the collision is what creates the disaster. Because in a high leverage, high exposure environment, it doesn't take much to knock the first domino. So, what's the first domino in 2026? Here's my best grounded answer. The first domino is a loss of confidence in the exit plumbing. Not Bitcoin, the exit plumbing. And the biggest candidate for that, in my view, is a stablecoin liquidity event combined with exchange-level risk controls. Let me explain why this combination is so nasty. Stablecoins are the grease in the crypto machine. They're the unit most people use to move between risk and not risk, without touching the traditional banking system every time. They're how liquidity moves fast. So if there's ever a moment where the market questions whether stablecoins are clean, redeemable, or transferable without friction, the machine slows down. Then people rush to convert stablecoins into something else, or they rush to redeem, or they rush to move off platform. Exchanges see a spike. They flip risk controls. Withdrawal limits, delays, extra verification checks, longer processing windows. Sometimes it's justified, sometimes it's just panic management. But it all feels the same from the user side. And now the market experiences something worse than price down. It experiences access uncertain. That's when you get disorderly selling. Not because everyone wants to sell, because everyone wants options. Options are oxygen. If you can't breathe, you don't care what the wallpaper looks like. You just want air. So the Black Swan is that moment, the market collectively questioning whether it can move and settle value when it wants to. That's the disaster. Now, I can already hear the pushback. You're fear-mongering, stablecoins have survived a lot, exchanges have improved, Bitcoin has matured. Yes, all true. And do you know what that means? It means the market has more confidence, and high confidence is exactly what creates complacency. Complacency is how black swans do damage, because people stop holding optionality, they stop holding dry powder, they stop holding time, they start holding, I'll just figure it out. and I'll just figure it out is not a plan when the market moves faster than your brain. So let's make this vivid with a simple scenario. Imagine Bitcoin is at a level everyone likes. It's not important what level. It's high enough that the room feels optimistic. Now a rumor hits. A major stablecoin issuer is facing a sudden legal constraint, or a major banking partner issue, or a redemption bottleneck. It could be a real issue. It could be an exaggerated issue. In a Black Swan, the difference matters later, not now. The first hour, price dips. Then traders smell blood. Funding rates flip, liquidations start, perp markets accelerate the move. Now retail sees it. The buy the dip crowd shows up. That actually helps for a minute. Then the second wave arrives. Risk desks reduce exposure. Funds de-risk. ETFs see outflows. Not because Bitcoin is broken, but because mandates are mandates. A fund that has a rule has to follow the rule. And at this point, something subtle happens. The narrative shifts from dip to event. And once the market smells event, it stops bargaining. This is when spreads widen. This is when order books thin. This is when you get those candles that look like someone pulled the floor out. Now add exchange level friction. A few platforms slow withdrawals. Some users get hit with extra KYC checks because they're crossing thresholds. Some users realize their accounts aren't fully verified. Some users realize their bank rails take days. And the panic becomes personal, not the market is down. My money is stuck. That sentence has ended more crypto careers than any bear market chart. Because when it gets personal, you stop thinking in probabilities. You think in absolutes. You start imagining worst-case stories. You start making decisions to relieve anxiety, not to maximize outcomes. And that's when people lock in losses that they didn't have to lock in. Now, I'm going to insert a very specific policy-compliant disclaimer right here, because it matters, and because too many people in crypto act like warnings are the same thing as advice. This might shock you, but I'm not a financial advisor and nothing in this video is financial advice. Cryptocurrencies are highly volatile and you could lose all the money you invest. You should always do your own research and consult a qualified professional. After all, your investments are entirely your responsibility, and you should know that nothing is ever guaranteed when it comes to investing. Neither I, this channel, nor YouTube are liable for any losses. And this video is for entertainment and educational purposes only. Now back to the real point. If you want to know whether a 2026 crash becomes a disaster for you, it comes down to one question. Do you have time? Because time is the only hedge you can't buy in the moment. If you have time, a crash is a price event, painful but manageable. If you don't have time, a crash becomes a life event. It forces you to act. And if you're thinking, I'm not leveraged, so I'm fine, let's challenge that. Leverage doesn't only mean margin. Leverage can be emotional. Leverage can be lifestyle. Leverage can be, I promised myself I'd never go below this number. Leverage can be, I need this money in 6 months. So I want you to be brutally honest with yourself right now. If Bitcoin dropped 50% quickly, would you be annoyed or would you be in trouble? And don't answer with pride. Answer with math, because the market doesn't care how strong your conviction is. The market cares whether you're forced to act. Now, I'm going to zoom out and connect this to the bullish liquidity thesis, because that's where people get confused. If the system has to print and liquidity eventually returns, doesn't that mean every crash is temporary? Maybe. Over a long enough horizon, maybe. But the danger is the path. A crash can happen first, and the policy response comes later. And in that later window, you can still get destroyed if your positioning is wrong. That's why the bad news is good news idea is both comforting and dangerous. Comforting because eventually policymakers tend to respond when things break. Dangerous because eventually can be after the damage is done to you. So the game isn't predicting the exact top or bottom. The game is being unkillable during the window where uncertainty spikes. Let's make it practical with 3 layers of protection. Not advice, just a way to think. Layer 1 is access. Can you access your assets when you want? If everything you own is on one platform, you're taking a platform risk you might not be pricing in, not because the platform is bad, because stress reveals constraints. Layer 2 is time. Do you have a timeline that can survive a nasty drawdown? If you need the money in the next year or two, that's not investing. That's a countdown timer. And countdown timers and volatile assets don't mix well. Layer 3 is psychology. Do you know what you do when you're scared? Most people don't. They think they do. They don't. You only learn it when the market tests you. So here's a simple exercise you can do mentally. Imagine you're down 35% in 10 days. What do? Do you buy more? Do you freeze? Do you sell a little just to feel safer? Do you start scrolling for someone to tell you it's fine? Whatever you answered, that's your strategy, not the one you wrote down, the one you actually run. And the reason I'm pushing this so hard is because black swans are mostly psychological events with a financial wrapper. Now let's close the earlier open loop about how you're holding Bitcoin. In 2026, a big chunk of Bitcoin exposure will be held by people and entities who don't behave like OG Bitcoiners. They behave like portfolio managers. That's not an insult. It's a different incentive set. Portfolio managers have rules, they have monthly reporting, they have risk committees, they have allocations, they have drawdown limits. So when volatility spikes, they can become systematic sellers even if they believe in the asset. And that selling can pressure price in a way that feels unfair if you're used to retail-driven cycles. This is why a crash can be sharper even in a more mature market. Maturity brings bigger pipes. Bigger pipes can drain faster. Now let's talk about the part people always get wrong. How low could Bitcoin go? I'm not going to throw out a clean number like it's a prophecy. That's not helpful. What is helpful is to understand why the downside in a black swan overshoots what feels reasonable. It overshoots because liquidation is not valuation. Liquidation is urgency. In a panic, price is set by the most urgent seller, not the calm buyer. And the calm buyer is usually waiting for confirmation that the panic is done. So you get this ugly gap. Urgent selling meets cautious buying. That gap is where the air pocket forms. And here's the part most people miss. The air pocket can happen even if long-term holders don't sell at all, because the marginal price is determined at the edge. The edge is where leverage and forced selling live. So if your plan for 2026 is basically, I'll hold through anything, that's fine, only if you can actually do it. Only if you're not forced. But if you're holding through anything while your funds are tied up on a platform that can slow you down and your life timeline is tight, then hold through anything is not conviction. It's hope. Now let me zoom in on the exchange piece one more time, because you selected it and because it's where a lot of people get hurt. If you use exchanges, the two big things that matter in a crisis are: 1. Do you have full KYC completed before you need it? Because in a stress event, platforms tighten, they don't loosen. If you wait until the day of chaos to fix verification, you're trying to solve a paperwork problem inside a market emergency. That's a bad mix. 2. Do you understand withdrawal routes and time? Some rails are instant until they're not. Some rails are fast until banking partners slow. Some networks get congested. Some fees spike. And some platforms prioritize internal risk controls over speed. So the black swan is not exchanges are evil. The black swan is you realizing too late that your plan required perfect conditions. And perfect conditions don't exist during black swans. If you want a calmer relationship with crypto, build plans that still work when conditions are messy. That's it. That's the whole secret. Now, I want to bring this home with the warning itself. When people hear 2026 crash, they imagine a slow bear market, a long slide, months of boredom. That can happen. It's not the disaster. The disaster is a fast crash that hits at the same time as an access scare. The disaster is a fast crash that hits when the narrative flips from risk on to risk off across all markets. The disaster is a fast crash that makes you question whether you can even execute your next move. So if you want one sentence to remember from this entire video, it's this. In a black swan, the problem is not your opinion of Bitcoin. The problem is your ability to act under stress. And if you can act under stress, you don't need to be perfect. You just need to be alive in the game. Now, let me give you a final mental reframe, because I want the ending to actually change how you think. Most people think the goal is avoid crashes. That's impossible. The real goal is don't let crashes turn you into someone you don't recognize. Because the biggest loss in crypto isn't the drawdown. It's the way a brutal drawdown can train you to stop trusting yourself right before the next opportunity shows up. So when you look at 2026, don't just ask, how high does Bitcoin go? Ask, what would make me panic, and can I remove that trigger now? And if you do that, a crash stops being a disaster. It becomes an event you can endure. Subscribe.